What happens when you're in control of your finances, your career, and your well-being? There's no limit to what you can achieve. I'm your host, JaeVic, bringing you on a journey through finance, fitness, and finesse. A podcast about developing your 8 dimensions of wellness. If you're looking to elevate your wealth, well-being, and discover the power of balance, join me bi-weekly, Mondays and Fridays, to learn why money matters, but wellness counts. Hey finessers! Welcome back to another episode of More Money Mondays, where we break down confusing financial jargon, stigmas, and assumptions to help you take control of your financial wellness. I'm JaeVic, and today is all about increasing our credit knowledge. We will go over the basics of credit, including the history and impact of credit cards on our economy, plus how to choose the right card for your needs. Let's get into it. You guys know me. With my therapist background, I advocate to make true change, we have to look at the roots. And speaking of roots, I'm a major plant lover. If you've ever dealt with rotten roots suffocating in waterlogged soil, you know how tough it is for those plants to recover. It's the same case with credit. Now, if you tuned into the last More Money Mondays episode, You're Such a Loner, you might remember that loans and credit date as far back to ancient Mesopotamian times. This is linked in the show notes in case you missed it, but fast forward to modern finance, it's important to understand how credit cards played a major role in boosting the economy after World War II. That journey since the 1940s has led us to the trillions of dollars of debt we face as a country today. After World War II, consumer spending skyrocketed. People were eager to buy goods and services that had been scarce during the war. As the economy shifted to peacetime production, businesses sought ways to encourage spending and make purchases more convenient. That's where credit cards came in. At the time, credit cards seemed like the perfect solution. They offered the convenience most of us know to buy now and pay later, but this boosted falsified consumer confidence and spending. This surge in spending did fuel economic growth that was needed during the post-war period. I will give credit cards that. The introduction of the first universal credit card, the Diners Club card in 1950, and then the launch of the Bank M.O.R.E card, which later became Visa in 1958, solidified credit cards' role in the economy. These cards provided a line of credit, allowing people to buy things they might not afford up front, which spreads the cost over time. The increased demand for goods and services also helped businesses grow and contributed to the overall economic expansion that the United States was looking for. But since the 1940s, credit card debt has become a nationwide nightmare. The introduction of universal credit cards paired with aggressive marketing made it easy for many to get and use credit cards at the time, which of course led to increased debt. Add in the post-World War II societal expectations and advertising that encouraged people to buy more, and you have an out-of-control spending frenzy. Today, not much has changed, and economic changes like stagnating wages and rising living costs also drove many to rely on credit cards to maintain that standard of living. The ease and convenience of using credit cards caused an increase in impulsive spending, and economic downturns over the decades forced many without cash flow management to cover essential expenses with credit. And we have all witnessed lifestyle inflation, where people feel like they need to increase their spending as their incomes rise. The beast of lifestyle inflation was fed by credit cards. And what do you think happens when expenses outpace income growth? Debt city and inflation nation for generations to come. The convenience of credit cards came at a high price. Honestly though, using credit cards can be as simple or as complicated as you make it. The good news? If you stick to a few basic rules, you can keep your relationship to credit pretty smooth and stress-free. Here are 2 golden rules of credit usage. Don't spend more than you make, and always pay off your balance every month on time. As finessers, we need to keep learning how to play the game smart and make credit work for us, not the other way around. When researching for your first credit card, or any card for that matter, you'll want to find one that works for you and your current financial needs. Secured and student cards provide options for people who need to build credit from scratch. A secured card is backed by a cash deposit from the cardholder, which acts as collateral and usually determines your credit limit. On the other hand, an unsecured credit card doesn't require a security deposit and is based on the cardholder's creditworthiness. We'll get into what that means in a second. I'm sure some of us have experienced the challenges and intimidation behind getting a credit card with no credit history. I was there at some point too. Your credit history is your record of borrowing and repaying money. If you have a limited or bad credit history, it's often harder to get credit. Lenders are usually hesitant to extend credit to someone with no credit track record because they can't assess the risk. Many students graduating from school are blocked by the "you need experience to get the job." It's the same with credit sometimes. You need credit to get credit. But how am I supposed to do that if I can't start in the first place? Secured credit cards and student cards are a good starting point because they're designed for people who are new to credit. Some cards also offer pre-qualification, which lets you check if you're likely to be approved without affecting your credit score. I started out with the Discover Student Cashback back in my undergrad for the easy use and practice of using cashback categories. Cashback is a credit card reward program where you earn a percentage of your purchases back as cash. Now, don't let that get you too excited because it's not like it's completely free money. Sometimes it can incentivize people to buy things that they wouldn't usually buy just for a small amount of cash back. Please don't fall into this trap. Although, it is nice to get a little money back for the typical things you buy, such as groceries, gas, utilities, etc. Be sure to check out the show notes for a list of credit cards you can get with no starting credit score. The first step in shopping for a credit card is considering your spending habits. For example, could you benefit from earning cash back on gas or groceries? Do you frequently travel and want to earn points or miles? Are hotel discounts important to you? Finding your spending patterns by paying attention to what you purchase today can help you choose a card that offers the most benefits for your lifestyle. This way, you're not just using credit, you're making the system work for you. You know what More Money Mondays are for, breaking down terms in a way we can all understand so we can build our financial fluency and make money moves even with limited income. In this segment, I'm going to go over the basics of credit we should all know. This isn't an exhaustive list, and I'll have more episodes to break it down further, but it's a good starting place. Remember to be patient with yourself. Rewind, re-listen, or slow down the playback speed if you need to. Any terms I use in this episode that I don't define were probably covered in previous episodes, so support yourself and circle back to those in the show notes. Okay, let's talk about your credit score. Our country has made credit, or rather credit score, king. Your credit score is a number that shows how creditworthy you are. Basically, it's a number that shows lenders how risky it is to lend you money. It affects your ability to get loans, credit cards, and sometimes even housing or jobs. Your credit score is calculated based on criteria like payment history, amounts owed, length of credit history, new credit, and types of credit used. Lenders use your scores to determine whether you're a risky borrower. Higher scores show that you're responsible, making payments on time, and managing different types of credit well. The FICO model, which is used by 90% of top lenders, ranges from 300 to 850, with levels labeled as poor to exceptional. FICO stands for Fair Isaac Corporation, which is the company that developed the widely used credit scoring method. I cannot stress enough, guys, how important paying on time is to your financial health. Your payment history is key because it makes up 35% of your credit score. Late payments create a spiral of problems leading to late fees, interest charges, and a falling credit score. This can make future loans more expensive for you due to the higher interest rates, so please set reminders and take responsibility for your due dates whether you use credit or not. Maintaining a low credit utilization ratio is also beneficial. This ratio is the percentage of your credit limit that you're using. Maxing out credit cards or facing increased interest charges can lead to high credit usage, which isn't good for your score, so please, spend within your means. Opening too many accounts too quickly can also hurt your score. Each application results in a hard inquiry, which can temporarily lower your score. Try to space out credit applications over time. If you get a credit card, try to have it for a year to 2 years. Don't just be getting credit cards and then 3 months later get a new one. It's not going to go well. Plus, you have more cards to manage, more payments to manage, and you need to simplify your portfolio before you can diversify it. A hard inquiry happens when a financial institution checks your credit for a lending decision, while a soft inquiry doesn't affect your score and is often done by you or a potential employer. A credit report is a detailed record of an individual's credit history. It includes information on your credit accounts, payment history, outstanding debts, and public records such as bankruptcies. Lenders use these credit reports to assess your creditworthiness when you apply for loans or credit cards. The more creditworthy you are, the better deal you'd be able to negotiate on your loans. That means interest rates that won't kill you. Last part is we have to continue to build our understanding of interest rates and fees because they are always lingering. APR, or annual percentage rate, is the interest rate for a whole year, not just a monthly rate. You've also heard me mention APY in previous episodes. I know what you're thinking. Great, more abbreviations. Why are there all these random letters that go with so many things in finance? I know it's annoying, but here's the difference between APR and APY. APR is mainly used for loans and credit products, such as credit cards, personal loans, mortgages, or auto loans. APR represents the yearly cost of borrowing money, including interest and any fees, and is helpful for understanding how much you'll pay for a loan or credit over a year. APR is the interest that is in favor of the lender, not you, the consumer. APY, on the other hand, is used for deposit accounts and investments such as savings accounts, HYSAs, certificates of deposits, otherwise known as CDs, money market accounts, and other types of investment accounts. APY measures the amount of interest you'll earn on your money over a year, considering the effect of compounding interest, which means earning interest on both the initial amount of money you put down and the interest that's added to it. APY gives us a clearer picture on how much your money will grow in savings or investment accounts over time. So APY is the interest that's applied to your money in your favor. When you get your credit card bill, you may notice a minimum payment option. This is the smallest amount you can pay to keep your account in good standing. It might seem like a good deal, but let's do a double take. Paying only the minimum amount is the trap that keeps you in debt. Credit card companies charge interest on any unpaid balance. So when you make only the minimum payment, the remaining balance accrues interest at morbidly high rates. Over time, you end up paying much more for the original amount you borrowed. For example, a $1,000 balance on an 18% APR could take over 5 years to pay off with minimum payments, and you'd end up paying over $500 more in interest alone. Guys, to avoid this trap, always aim to pay off your full balance each month to avoid interest charges, and use reminders or automatic payments to ensure that you're paying more than the minimum every month. Alright, let's talk about some consequences. I do this research for myself and our lifelong learner community because I care about our financial well-being. And let me tell you that credit card debt is suffocating. It can constantly weigh on your mind and might control every choice you make for yourself. You can end up emotionally and even physically drained from it. And even though you make regular payments, it feels like you can never make any progress because of the interest. It can skew your self-image and your self-worth. I've seen people make credit card debt a low priority debt because unlike missing payments on your mortgage or car loan, not paying your credit card bill won't immediately result in losing your stuff. When dealing with credit card payments, you should understand what happens if you fail to pay your credit card. While you're only required to make that minimum payment, doing so means it will take many years to pay off your debt, costing you thousands in interest in the long run. If you stop making minimum payments, your overdue status will show up on your credit report in increments of 30, 60, 90 days, and so on. Once your payment is 60 days overdue, the card issuer can increase your interest rate on existing charges. Eventually, the lender will just revoke your card privileges, but you'll still owe the debt. If your card is 180 days overdue, the issuer will likely write off or charge off your debt for internal accounting purposes. Charge off means a company has decided that they won't be able to collect from you, and they mark it as a loss in their books. However, you still owe the money, and they can still try to collect it from you. At this point, your account will likely be sent to a collection agency, which will report the account to the credit bureaus under its name, further impacting your credit score. Collection agencies are seen as bad because they can be very persistent and stressful to deal with. When you don't pay your bills, a collection agency takes over to get the money back. They might call you a lot, send you letters, or even take legal action to make you pay, which can be really overwhelming. Eventually, the credit card company or a debt buyer may decide to sue you for the debt, but this could take years and may never happen, especially for smaller amounts. If you are sued and you lose, the debt becomes more serious, potentially leading to wage garnishment, bank account seizure, or property sales. However, laws in some states do protect income and assets, so you may not have to pay anything immediately. Regardless, why even place yourself in this situation? Just pay your bills. If you're determined to pay off your credit card debt quickly, you're not alone. Over a third of Americans carry a balance month to month. It might seem discouraging, but with the right plan, getting out of credit card debt is possible. I'll have future episodes on methods to get out of debt, but by now I hope we all have an understanding of the basic language so we know what questions to ask. Time to bust it. Money myths holding you back. Myth: credit cards are fundamentally bad and should be avoided at all costs. If you know you're severely irresponsible with money and think that credit cards are a magic wand that can buy you whatever you want without you having any obligation, then yeah, maybe they are fundamentally bad for you. But I believe we can all find a way to achieve some sort of responsibility for ourselves and especially grow in our financial well-being. The truth is, credit cards can be a powerful financial tool when used with savviness and, of course, a little finesse. So throughout the episode, we've been talking about convenience. Credit cards let us make purchases without worrying about carrying physical cash. While debit cards do offer similar convenience without the risk of accumulating debt, credit cards have an added benefit: purchase protection. With so many people treating fraud as their full-time job these days, if your debit card gets hacked, your actual bank account money can be stolen, and getting it back can be tough or even impossible. But if you need to dispute fraudulent charges on your credit card, the process is much smoother and you still have access to the original cash in your bank account. One of the main advantages of credit cards is the detailed record of your spending they provide through monthly statements and online accounts. Some credit cards even offer yearly summaries, which can be super helpful during tax season for those of you old enough to file your taxes. But regardless, it can also just be a summary of everything you buy in a year. What are your spending habits? You gotta study yourself to know what you want to change. It's literally built-in record keeping to track your expenses. Another tip for maximizing your credit card use is to choose cards that offer discounts or cash back on your purchases. Many credit cards provide these perks, and it's worth comparing options to find the ones that best fit your needs and spending habits. I know some savvy users who are so good at using airline credit cards to get their flights paid for or the price reduced. Of course, these perks through the credit card are earned through regular purchases and timely balance payments, but if you travel a lot, having these benefits can be super helpful. Using credit cards in your favor means treating them like cash, only spending what you can pay off in full each month to avoid those hefty interest charges. You need to understand your card's terms and conditions, including interest rates, fees, and rewards. And please don't rely on credit cards for emergencies. Aim to build an emergency fund for unexpected expenses and use the credit card to support you from there. Ultimately, your money is your decision, and I want you to feel secure in that. What works for your friends or family may not work for you, and that's okay. Applying for a credit card is one of the big financial decisions you can make for yourself, so make sure it's worth it. Stay informed, stay disciplined, and of course, keep finessing your finances. Alright, finessers, that's all for today's episode of Gimme Some Credit. Key takeaway is credit cards can be a powerful tool in your wallet, but they can quickly become liabilities if not used properly. If you found today's episode helpful, please share it with a friend or family member who could benefit from this knowledge. And don't forget to hit that subscribe button so you never miss an episode of More Money Mondays. Got questions or topics you want to know more about? Hit me up on social media or drop a 5-star review and leave a comment. We're here to learn together. Until next time, I'm JaeVic, and I'll talk to you guys on Fitness Finesse Fridays. And if you don't know, now you know. Disclaimer: this podcast is for informational purposes only and does not constitute financial or mental health advice. Always seek professional guidance tailored to your personal needs.